China's government has pegged the renminbi or yuan at 6.83 to the dollar since July 2008, when the global economy went into freefall. An ever-vocal United States argues that this engineers a Chinese export trade advantage that's throwing Americans out of work. It wants the renminbi to float freely and so reflect its market value. But China insists that its managed currencies exchange rate is fair and that it's more focused on domestic stability than bowing to foreign pressure. With the assembly line unemployed numbering millions and factory margins squeezed to the low single digits, China's government would be damned domestically if it moves on the renminbi and damned externally if it doesn't.
Those concerns are often not very closely related to the economic reality or the fundamentals, but more of a political criticism.
The reality is that Chinese exports are rebounding robustly, registering a 46% year-on-year hike in February, albeit from a depressed 2009. The US, with a $200 billion plus China trade deficit, which has increased nearly every year since 1985, retorts the rise in exports is ample proof that the renminbi should appreciate. The spat could get messier in mid-April, when the US Treasury Department by law must declare whether China manipulates its currency. If yes, sanctions could follow. So will Beijing move? And if so, when?
It's probably going to start in the second half of the year and gradually moving up against the US dollars and towards 6.7 by the year end.
And more bullish economists forecast a rise to 6.4 renminbi to the dollar by July. Amidst this ever more heated debate, China says it's remaining on guard as there's still a possibility of another global downturn, which would mean more Chinese job losses and rising social tensions. But then again, it also can't afford a fully blown trade war.
If trade dispute becomes more widespread and trade protectionism becomes a serious threat, then the government would be worried that that will affect China's overall export growth and therefore the employment objective as well.
The government is also mindful of imports, which rose 45% year-on-year in February. This was primed by China's $500 billion stimulus package, which is spurring domestic demand, narrowing the trade balance, and now stoking inflation, which came in at a 16-month high of 2.7%. Huge inward flows of oil, minerals and metals are not priced in CNY, the Chinese yuan.
If the global commodity price continues to edge up, then that could give more reasons for the Chinese government to allow the CNY to appreciate against the US dollars, because those commodities are priced in the USD.
And China is also aware that many more upwardly mobile Chinese now travel abroad for business and pleasure than Americans, and they spend tens of billions of dollars overseas. By 2020, China is forecast to supply over 100 million tourists. This will be a valuable source of revenues for, among others, the US and Europe. It all begs the question, political considerations aside, is there a fair exchange rate benchmark for the renminbi? The Economist Big Mac Index is based on the theory of purchasing power parity, that if exchange rates were indeed fair, then a burger's cost in dollars would be the same anywhere in the world, unlike in China, where it's more than 40% cheaper than in America. This, of course, is a limited, light-hearted comparison, but it's food for thought. Burgernomics aside, China has another worry. It has $2.4 trillion in reserves, of which around a third is in US Treasury bonds. If the renminbi were to appreciate against the dollar, then in yuan terms, these reserves, plus any dollar-pegged inventories, would be worth less. And this has been fiercely debated in the Chinese media. But the fact is, most urban Chinese use or directly buy some imported goods, which means if the renminbi appreciates, they should be better off, which in turn could spur consumption. But there's little room for error. The government allowed the renminbi to rise 21% between 2005 and 2008, and this resulted in thousands of low-tech factory closures. Then came the Wall Street meltdown and global recession, which caused a further 20 million Chinese job losses. China is in no mood to heed lectures in finance and economics from the United States. China's high-end operations, however, appear unfazed. Innovators in areas like green energy, communications and medical equipment. And that's why China Incorporated is undergoing a structural shift to move up the value chain and so be less vulnerable to volatile market swings that force redundancies. This company, which designs and manufactures ultrasound-based tumour-dissolving technology, says the exchange rate has little impact on overseas business or profits.
For us, the market didn't exist before. We had to create a market, so we don't face this problem. Because right now, there's no established market price. We create the market, we determine the price.
But low-end assembly lines still far outnumber the innovators. That's why China is calling for breathing space. Just as the government controls the exchange rate, it needs to control the impact of any change. And this means preparing public opinion. The trouble is, with mid-term elections in November, the US administration has strategic communications goals of its own. Neither camp can afford to lose face.